COVID-19 has had a big effect on markets, economies, and individual companies around the world. And the first quarter of 2020 isn't a period that people will be forgetting anytime soon. We think there's some really important messages that individual investors and advisors should be considering as they're looking at their investments as well as their financial plan. There's three main messages that are really important during times of volatility. The first one is that portfolio falls can be thought of as temporary losses and only become permanent losses if clients or the advisor sells the assets in the portfolio. So the way to think about this is that these can be temporary falls that could even present buying opportunities. Those that tend to sell their investments after heavy market falls tend to lag those investors that stay invested throughout the cycle. During periods of heightened volatility, it's natural to want to exit, but we think selling at the bottom is a surefire way to lose money that you can't make back. So it's important to recognize when you see your portfolio move around, when you see portfolio falls, that doesn't equal portfolio losses. These are temporary periods, and the last thing that you should be doing is selling out. The second important message is that for investors that think about markets in a long-term way, market volatility can actually present an investment opportunity rather than a risk. A simple way of thinking about this is imagine that you have a farm and your next door neighbor has a farm. And he's a fellow that's heavily influenced by what happens to corn prices, which is the main product of the farm. Now imagine there's a day where the price of corn's down a lot. Well, he's very depressed and he comes to you and says, listen, I'll sell you my farm for 20 cents in the dollar. Well, the next day, let's say corn prices are up a huge amount. He comes and says, listen, I'm really optimistic. I'd love to buy your farm off you at 5 times what you think it's worth. Now, those days when he's very depressed and he's offering you 20 cents in the dollar, do you think that's a good time to sell? Often, that's the best time to buy. If you let the mood of the market determine whether you buy or sell, we think you're missing an opportunity. So the same way that your next door neighbor is influenced by the price of corn and whether or not to buy or sell his farm, we think investors are also influenced by that same mood swing. So the way to think about markets is when prices are down heavily, that can actually be a better time to buy versus selling. Markets aren't there to guide you on when to invest. They're there to serve you so that you can buy when prices are low and sell when prices are high. And history definitely supports the fact that if you'd bought after substantial market falls 3 to 5 years out, you tended to do pretty well. So we think it's important, if you think about markets in a long-term way, to reframe volatility as an investment opportunity rather than a risk. Thirdly, investment strategies and investment portfolios are there for a reason. They've normally been designed to achieve individuals' goals. So whether the portfolio is doing its job isn't about whether it's beating a benchmark or doing well versus a peer group. Often that can lead people to focus too much on the short term. The investment strategy is normally geared towards a longer term financial plan. The reason why that's important is that the longer term goals were designed with this type of market volatility in mind. A good financial plan has redundancy built in. So often during these periods, it's natural to focus on the short-term gyrations in markets. But we think if you can shift your focus towards your goals and ask the most important question, which is, am I on track? Am I on track to meet my goals? Investing success should not be measured by beating markets or beating peer groups. It should be measured by being on track to achieve your goals. So just to recap these 3 messages. Firstly, portfolio falls only become losses if you sell out. Secondly, for long-term investors, volatility can be an investment opportunity, not a risk. And finally, we should be shifting our focus away from short-term market returns towards goals. Investing success is measured by whether you're on track to achieve your goals. I hope everybody stays safe and stays focused on sticking to their financial plan. Thanks for your time.
Advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.